This is the mortgage rate that's going to cause all the real estate prices that we've seen to go backwards, meaning it's going to fall down. Want to find out what it is? Stay tuned to this week's episode of Prime Property TV. Promise you, it'll be worth it. Good day, Toronto. Welcome to another episode of Prime Property. So glad you joined me here today. 3.25%. This is going to be the mortgage rate that's going to start making the real estate prices start to reverse, meaning instead of accelerating and increasing, it's going to go backwards. And you know what the fun fact is? We hit that last week. However, there is going to be a little caveat I'm going to explain to you in this video, so make sure to stay tuned. Now, I've been saying that in the last, I would say 3 to 4 weeks or so, actually around that we'll see price acceleration slow down, meaning that instead of going up like 10, 15% every single month, which is wildly improper and unhealthy, we'll see a slowdown. And we'll see that next week when the numbers for March come out based on TREB, whether the prices reverse. But I don't think they're going to reverse, i.e. go down, but we're in that direction right now. But for us to get to that price reversal, we need to see a couple things. And I've been saying this for a long time. The first of many things that we need to see is that interest rate needs to be above 3%, meaning that the rate you're borrowing is above 3. Well, ladies and gentlemen, we hit it last week as the 5-year fixed mortgage has increased so many times, almost daily in the last week, that we are now over 3%. So for those of you who do not know, the 5-year fixed mortgage rate is very closely tied to the 5-year bond rate for the government of Canada. And here's a chart showing you what kind of parabolic rise it saw, courtesy of Ben from Edge Analytics. And you can really see on the right-hand side, it kind of went, showing the rapid increase. And every time that the bond rate goes up, the banks move the 5-year fixed. And because it went parabolic for many reasons that I'm not going to get into in this video, but it's here nonetheless. Now, let me explain to you why I used the 3% rate in the past, right? And this is because the stress test is always going to be the limiting factor onto what a buyer is able to get for mortgage, meaning their purchasing power, right? Which is the demand side of the equation. And if you forgot how the stress test is calculated, I'm gonna give you a little quick summary in terms of math of what and how this affects everybody. So the amount of mortgage you're qualified for is based on you specifically being tested at a higher interest rate, and that interest rate is whichever is higher of these two things. Number one, 5.25%, which is called the posted rate, or your contract rate plus 2%. So whatever your contract rate that the bank's giving you, in this case, a 5-year fix, you add 2 to that. So when the buyers are having their purchasing power reduced is when the mortgage rate is 5.25 minus the 2%, which puts you at 3.25, which is now a lower number than the 5-year posted mortgage rate for fixed mortgages that are being provided as of last week. If that was too much math for you, there's just one thing you need to remember, and it's this number right here, 3.25%, because that's the number that's important. Now, why this is important is it means if you go and apply for a mortgage right now for, say, a 5-year fixed mortgage, you are now going to be qualifying for less mortgage than you would a week ago, or if you go get a variable mortgage. This is the key, however, I was mentioning. The amount of mortgage you qualify for under variable is now higher than what you qualify under fixed, because the ways that you're calculating the stress test is different, because the variable rate is still lower than that magic number of 3.25. Ultimately, meaning we have half of one of the boxes and my criteria is checked off for real estate prices going backwards. But to get a fully checked box in this manner, we need to see the variable mortgage rate increase past that magic number of 3.25. Currently, it is still sub 2% right now for most end users. And to give you a lay of the land of kind of the spread between the fixed and the variable, here's a chart showing you how big of a chasm it is right now. Now, you can also see that the spreads have really kind of get blown out of proportion and gotten incredibly high ever since the pandemic, because the Bank of Canada pinned the overnight interest rate to the floor, right? Right now it's at 0.25 because they increased it last month. And the only other time we saw the spread this high was in the early 2010 10s, meaning that it's been a decade since the spread was that high. Now, this is why you can see in the last 2 years, the amount of variable mortgages have increased because the savings on the variable were that much bigger than the 5-year fix. So you can see in this chart here, despite previously the most popular mortgage being a 5-year fixed of most Canadians, the variable has surpassed that. And I would say for Canadians, they liked it, is guessing they're more conservative and they wanted a safety of a 5-year fix. But all my clients, when they work with me, know go variable all the way because of a ton of reasons why, but I'm not going to get into that in this video. Now, I suspect more people will be getting a variable now because for, to save enough money using a fixed, the Bank of Canada's overnight rate that affects the variable rate, the interest rate, has to go up 1.5%, or what is the equivalent of 6 times of the 0.25% increment increase. And I know there's a specific Scotia economists predict that we're going to get that. I'm still very much on the fence that we're going to get less than 3 0.25 interest rate hikes. One has happened already because inflation should, in theory, I think, peak at the end of Q2 when we're comparing it year to year from last year. Fun thought for you, just as a marketing idea for the bank's perspective, isn't it kind of like a great idea to tell Canadians to lock into a fix because you're going to say the interest rates are going higher? Aren't you kind of baiting the general population to think that there's 8 interest hikes? So if this was a marketing idea by Scotia, bravo, right? That's Scotia playing a game of 3D chess while everyone's playing checkers. But I digress, right? However, if the war is continually going on, in Russia and Ukraine, I've kind of changed my stance on that. We'll probably get more increase in interest rates due to the commodity shortage, specifically being wheat and gas. And I know I've said in the past that while I think the war can provide more cover for the central banks like the Feds to not increase the interest rate going forward, I think the fight against inflation is likely going to be a bigger storyline, and there's going to be more pressure from that perspective to actually increase the interest rate, right? So the central bankers like Bank of Canada and the Feds can't really not look at it from a different perspective, and they need to look like they're fighting inflation. So they have to increase the rates. But let's be real, right? Is 0.25% increase going to fight 5.7% inflation in Canada? 7.9 inflation in US, right? It's not. So it's kind of like the analogy I'm telling a lot of clients. It's like trying to put out a forest fire with a garden hose. Look, it's just not going to work, right? It's just not. You can see over here, the interest rates that are negative right now, and they'll continue that way until some massive increase in overnight rate. And I don't think it's going to happen. Now, this is the type of real estate content you enjoy. Make sure to help us spread the knowledge out there by smashing the like button and subscribing to the Prime Property channel, because every week we put out awesome content like this where I actually break down something in long detail for this mortgages specifically, so that we can be honest and transparent and tell you what the heck is going on in the real estate market right now and kind of what we're telling our clients to do. And all this real talk is we want to be top of your mind so that when you're ready to buy, sell, or invest in real estate, you'll think of our real estate team, myself, and you'll book a call with me using the link right here. It's www.chatwithzen.com. Now, one of the things I'm interested in seeing kind of what happens to all the people who have had a mortgage renewal coming up when they previously had a 5-year fix is kind of over here on the chart. You can see that when people who got a mortgage in 2017, the renewals are coming up this year. So 2022, right? 2017 plus 5, you got your 2022. And they're going to actually see an increase in the mortgage payment of roughly $60 per $100,000 that they borrowed when they bought the place in 2017, right? So if we apply this to the GTA, Greater Toronto Area, you can see that the average price in 2017 was, yes, sub $1,822,000. And if you get a loan to value of 80%, meaning you get a 80% mortgage, that means your mortgage is about $657,000, give or take, something like that. So you're almost at an increase of $400 a month if they renew in those exact same terms that they got before on a fixed 5-year mortgage. However, as I mentioned before, borrowers have the option to go variable right now if they can't absorb the $400 a month payment, or you just re-amortize your schedule of your payment, which means you extend your mortgage from whatever you paid off back to 30 or 25. So this isn't kind of like a de facto way that prices are coming down and people renew, they're screwed, and that's going to reprice, because if you look at this chart over here, you can see that the average home equity in Canada is massive. It is massive. It was like 72% last year when I last looked at this. It's now 74% because it's gone up 2% in Canada. This is why Canadians will do everything in their power to make their mortgage payments and not default on their properties. So anybody who thinks that, Canada, because prices are going up so quickly, we're like 2008 great financial crisis US crazy, we're not. It's got some structural deficiencies that aren't even close, other than the prices escalate like ridiculous, right? I do see the comparisons. And as real estate prices rise, you can see that real estate asset as a household in this chart keeps increasing as well. Now, both these charts, remember, if there is a market correction, always comes down. And I really doubt many Canadians are kind of rebalancing their asset based on how much real estate they own right now. If anything, because of this chart over here, you can see that the amount of mortgage volume has increased. I think Canadians are actually doubling down on real estate. And we kind of see that in the last 2 years. Is it going to continue? We don't know. It could be, it could not be. But all of this has to do with interest rates. And this is exactly why I made this video, because the mortgage rate you're borrowing at now is still, regardless of everything I told you, deeply negative relative to what inflation is. And I've been saying that and harping on it for a very long time. Interest rates are still negative. It's well below the numbers you can see over here. And if you kind of look at it from that perspective, you're effectively being paid to borrow money when inflation is higher than your mortgage rate. This is why I call you're shorting the Canadian dollar, because you're going to pay it back in cheaper Canadian dollars because you know it's going to get devalued. Can this change in the near future? Yes, absolutely yes. We'll need to see the Bank of Canada increase the interest rate really high, which affects the prime rate on the variable mortgage. And when that happens, yes, now both criteria are checked that they're both above 3%. However, one of the things I've seen recently is that the discount on variable has been reduced already. And again, I'm going to give you a little bit more technical analysis. Here's a quick summary of how it works. Your variable mortgage rate for the bank is your prime rate, right? And for most banks right now, it's 2.7 because it went up recently, plus or minus some rate. And this plus or minus some rate is generally a discount. And the last mortgage I saw on an investment property was 2.35%, or the discount on the prime was the variable rate, which was 2.7 minus 2.35, which is 0.35. 1 month ago, the discount was actually 0.8%, and the prime was 2.45, which meant your variable was 2.45 minus 0.8, which is 1.65%. You see, the prime rate went up by 0.25%, and the bank discount went down by 0.45%, give or take. Don't want to do live math right now, which effectively increased your variable mortgage rate by 0.7% instead of the 0.25 that you read in the headlines when the Bank of Canada increased it, right? So if that was way too much math for you and none of this explanation made any sense, look at it this way. The banks can control the variable interest rate by changing that plus or minus thingy at the end of the prime so that your discount gets reduced or increases, or even better yet, you could pull a TD and change prime altogether a few years ago. But this is all to say this. While the Bank of Canada can control the overnight interest rate, which does affect at the end of the day the prime rate, it's up to the banks, right? Your TD, Scotia, CIBC, RBCs, to increase and decrease it. And it becomes a game of chicken between all those big banks on who is going to decrease that discount first or increase that discount. And one final fact I'll point out to you is that most banks increase the amount of discount that they have closer to the summer. Meaning if you maybe wait a little bit to close your properties, maybe call it May or June or so in the summertime, there's a very likelihood that your variable interest rate will come down because it happens most of the time, actually every single year. And to give you an idea, it's usually one bank that starts the trickle effect of all of it to go down. And last year, if anyone remembers, HSBC came out with the 0.99% insured mortgage that kicked off everyone discounting their mortgage rate, right? So are we going to see it potentially in the summertime? I would give it a high chance. History has a very likelihood of repeating itself. Yeah, Now, if you made it this far in the video, good for you, because some of this technicality, when I talk about interest rates and all that stuff, when I tell it to my wife, she's like, that's not fast, right? But here's my underlying theory of what's happening. If we continue to see the fixed rate increase at the rate we're seeing, it will very much increase the chance of the prices going backwards, right? In the real estate market. And as it removes a lot of the buyers out of the market, it's going to have a lot of inventory build up. But you have to remember this. In order for prices to decrease, I talked about it in Tuesday's video, right? We need to see the months of inventory past 5, history speaking wise. You can see in this chart over here. Now, this is the updated chart in case you missed last week's video. It includes 2021 and 2022 numbers, and I'm gonna repeat it again here for you. We need to see inventory past 5 before we see a decrease of price. And so far in GTA, we're at 0.9. That means we have a lot of inventory to build up. However, if the inventory does increase like we saw in the last 2 weeks where no one's buying anything and everyone's kind of on the fence and they're not making any moves, yes, the inventory can increase that much faster as the demand side is weakening because of the mortgage rates. So if the fixed rates hold, if the variable rates go up some more and inventory builds, yes, we're going to see a price reversal. Those are my 3 check boxes I'm looking for. Has it happened yet? No, not yet. But however, to my however is this. Right now is a normal seasonality when we get more listings because it's after March break and spring market. It's always kind of like everyone gets the house ready to sell after March break so that they can close on the next purchase that they bought and the kids finish school in the same school year, which ends in end of June, which is kind of seasonality when it comes to selling detached homes in Toronto. So that is kind of normal. But for me to like fully brace that and agree that prices are reversing right now and be in that boat, I want to see inventory build up rapidly, which again, I'm not saying it won't happen. It can happen. I'm just not quite there yet right now because it kind of, again, feels like a game of chicken between the buyers and sellers right now, plus a little bit of seasonality norm. But I do agree that the sentiment is changing and sentiment can change quickly. So I will keep you posted on the next 2-3 weeks as normal of what the heck is happening. Now, for me personally, I've told most of my clients at the start of the year that if you're buying more than one property for investment, I'd hedge both sides, meaning buy now in January before prices run up, which I was correct. And we saw a silly 30% increase, and then wait for potentially the mortgage rule changes, which I talked about last year as well, or the interest rate hike that we could definitely see. And I said 3 again at the end of last year. So we're now at that second part where we're getting increase in interest rate and potentially the mortgage rule change for investors. And that second part of the hedge is coming now. This is why it's important to actually know the strategy you're working with and the goals on how to navigate the real estate market because everyone's situation is different, right? If you're not buying 2 properties like some of my investor clients, then maybe you have waited this long or maybe you FOMO'd into buying something. It really is up to you because in real estate, you can make money when the market goes up. You could also make money when the market goes down. You just need to know exactly how to navigate both sides and how to win whether the market is going up or down. Now, if you're wondering how you specifically should navigate this real estate market, depending on what your goals are and what you're trying to accomplish, you could book a strategy call with me. You can use the link right here. It's www.chatwithzen.com. And hopefully this long-winded video of mine gives you an explanation of what the heck is happening on the mortgage side with the real estate and with the prices are reversing, kind of my stance on all of this. Because there's a lot of stuff out there. You can read the markets crashing, you can read the markets increasing. And if you really enjoy these kind of longer explanation on my take of what's happening in the market, let me know in the comment section below. I'm more than happy to create more content that's similar to this. And if there's a topic you want me to add to it, you can also put in the comments as well. So until next time, your move, your future. See ya. Now that you're done watching this one, how about this one? Oh, you know what? This one's good too. Ooh, this one's really good. You know what? Just watch them both.